All right, welcome to. This is like the second last video of Unit 3, so this is pretty exciting stuff. But today we're looking at reporting for profit. Before we begin, make sure you like, share, subscribe. You know all that stuff. And get the word out. Show 'em accounting can be fun. But anyway, we are looking at reporting for profit today. So I think the first thing we need to do is say, what is profit? Now, profit is the residual leftover revenue after you've deducted the expenses for that same period. And it's summed up in a nice, tidy formula of net profit equals revenues minus expenses. And what does that tie in with? Well, the two assumptions it ties in with are the period assumption and the accrual assumption. So if you ever have to talk about any of the assumptions, especially for this little subtopic, here's a good starting point. So the period assumption is dividing the life of the business into arbitrary periods to determine, in this case, profit for a particular set period. Those arbitrary periods can be yearly, monthly, half yearly, it can be daily if you want, but they're all arbitrary periods. And the accrual assumption, which ties into this period assumption, is the revenues and expenses are recognized in the period in which they occur. And that means we can calculate profit for that period. So period and accrual assumptions here are very closely linked. So what we're going to do here is we're going to have an overarching example of a trial balance, and we're going to look at the revenues, the expenses, and then we're going to introduce a new concept called the P&L summary. Then we're also going to close off drawings, and we're going to make an income statement. So that's sort of the general gist. And then we're going to do some theory around what this looks like, and namely financial indicators. So that's sort of where we're going to be. So anyway, looking ahead, we're going to go with our full example here. That one, there we go. So our full example, you've got the trial balance on screen, and you can see here we've got accounts payable, accounts receivable, bank, capital, cost of sales, discount expense, discount revenue, drawings, GST clearing, inventory loss, loan, sales returns, shop fittings, wages, and water supply expenses. Now, a lot of these, we'll be able to pick out what's a revenue, what's an expense. But the thing is, we also need to deal with this in ledgers and in the journals, because we don't balance off revenue and expense accounts like we do an asset account. We don't balance those off. So we need a way to deal with this, and that's called the P&L summary. But first, let's make a little method. So, how do we do all this? So the first thing we're going to do is we're going to close off our revenues to the P&L summary. We're then going to close off the expenses to the P&L summary. We're then going to close the P&L summary. Yes, we've already opened the P&L summary. We're now going to close it straight away to the capital account. We're going to then close drawings to the capital account. And then lastly, we're going to use all that information to create an income statement. Now, I know I've sprung a new account on you, the P&L summary, so let's talk about that now. So the P&L summary account essentially is a holding account for either profit or loss, and what we use as a mechanism to close off our revenue and expense accounts. So let's bring back the trial balance you see for Carl's Caverns here. What we're going to do is we're going to highlight all the revenue accounts. So that's discount revenue and sales. They're our two revenue accounts. There's no inventory gains, so we don't have to worry about that. But the other one we're going to tie here is sales returns. And the reason we're going to tie sales returns in is because that links to sales. So we need to close those accounts off. So how does that look in the general journal? You can see here, on this December 31st, we've got discount revenue, sales returns. And we see here, if we use discount revenue, looking at the trial balance, we see discount revenue, credit balance of 500. To close it off, it needs to be 0. So that means discount revenue, debit 500, sales 82,500, and the sales returns being a debit balance of 2,500 will then be a credit here of 2,500, leaving us with a total revenue of 80,500. And on the P&L summary side, on the credit side, we're going to put 80,500. And how do these look in the ledger? So let's bring the sales ledger and the sales return ledger. We can see that information is all there. You've got the credit sales for the month, accounts receivable, and the P&L summary, 82,500. That is 0, closed off for December. Likewise, sales returns. But then if we go to the P&L summary, we see here December 31 revenues. So the cross-reference isn't discount revenue / sales returns. It's just revenues. And that's 80,500. So we've done step 1. We've closed off our revenues. We then close off our expenses. And now we're going to highlight the expenses here. So we've got cost of sales, discount expense, inventory loss, wages, water and supplies expenses as our expenses. And we see here, for example, cost of sales is 50,000 on the debit side. So obviously we need to make that 0 as well. So what we'll have here is cost of sales, discount expense, inventory loss, wages, and water and supply expenses. All those entries will be credit, and it'll be what the balance is as per the trial balance. So cost of sales, credit 50,000, discount expense 400 on the credit side, inventory loss credit 300, wages 11,000 credit, and water and supply expense 15,000. That gives us a total. That's the total credits, and the total debit here will be P&L summary 76,700. Now, if we have a look at the general ledger here, for cost of sales, you see debit 50,000 and the cross-reference inventory. That indicates our cost of sales. And then we go P&L summary 50,000. And that tells us it's going to be 0. Next, you've got wages 11,000. Same concept. We need it to equal 0. But what about the P&L summary? We see here, you just go onto the debit side, you go expenses, 76,700. So the P&L summary operates almost like a pseudo owner's equity account, where if it goes up via, say, revenues, it's a credit, and if it goes down via, say, expenses, it will be a debit. So right now, we've got debit 76,700 and revenues 80,500 on the credit side. So credits are currently higher than debits. That means we've made a profit, but P&L summary is just a holding account, so we need to close that as well. So how does that look? Well, if we deduct our revenues from expenses, we see that revenues are 3,800 higher than our expenses. So that means our credit is higher than our debit, so we need to make sure that account is 0 as well. Ergo, we want to have a debit of 3,800 to the P&L summary, and that is closed off to capital, which, because we made a profit, capital goes up 3,800. And that's a credit again. And how does that look in our P&L summary? Quite simply, you see here capital on the debit side 3,800 and it totals 80,500. Likewise for revenue 80,500, and in the capital it's just P&L summary on the credit side because that indicates profit. So a few quick rules. So there's only 2 rules here, well 3 technically. Firstly, if your credits are more than your debits in the P&L summary, you've made a profit because revenue is higher than expenses. If your debits are higher than your revenues, then it's a loss. And lastly, if they're equal before you have to close the account, it means you haven't done anything. No profit, no loss. So just making sure you're aware of the debits and credits there. And P&L summary must always equal 0. So how do we close drawings? So if we go back, we look at drawings, we can see drawings was 2,000 on the debit side. So debit 2,000 on capital, and drawings credit 2,000. And that means our drawings will be 0 because debit 2,000 when we took the money out and credit to close it off. Now, the capital account, we can see 45,900, my mistake. We've got the profit we previously did, and this time the drawings has been closed off. And that is everything there. And then when we close the general ledger for capital, we see the balance 47,700 because credit is higher. So, what does an income statement look like fully formed? So you've got the sales revenue, discount revenue is all the information that will go in that revenues section, and that includes sales returns. Whereas expenses, that's going to include cost of sales, which goes in the cost of goods sold section, along with discount expense, inventory loss, wages, and water and supplies expense. So we've got that information there. And we convert that info that we've done from our general journal into our income statement. So you've got sales less sales returns, 80,000, less your cost of goods sold, 50,000. That gives us a gross profit of 30,000, less inventory loss, 300. So that gives us an adjusted gross profit, 29,700, and we add our discount revenue at the end, which is 30,200. Obviously, inventory loss used to calculate adjusted gross profit. Now, any other expense that's not inventory loss, inventory write-down, or cost of sales, or any period costs, like cartage in, will go in the other expenses. So your discount expense, wages, waters and supplies expense, all goes in to the other expenses. And that leaves us with a net profit of 3,800, which conveniently lines up with our P&L summary. So that ties in. Now, one question I have seen in previous years, I think we do need to address, is if I put the sales returns, will that impact the P&L summary? And the short answer is no. You're still going to reach 3,800. It's just going to look a little bit different. You would lose a mark, but it won't negatively impact. You'll still get a profit of 3,800. So just be aware of that as well. So just remember, sales returns goes with sales into revenue. So financial indicators now. We're only going to look at 2. So the gross profit margin. This indicates the appropriateness of our average markup by calculating percentage of net sales revenue that is retained as gross profit. And all it is gross profit margin equals gross profit divided by net sales times 100, because you want it as a percentage. Likewise, net profit margin, this indicates the expense control, total expense control, by calculating the percentage of net sales revenue that is retained as net profit. This time, net profit over net sales times 100. So if we would apply it here, that would mean that 30,000 divided by 80,000 times 100, while the net profit margin is 3,800 divided by 80,000. So some things to note here is that, firstly, your net profit margin will always be lower than your gross profit margin. So we're going to have those numbers on the screen now. What can we use the income statement for though? And what can this indicate to us? Firstly, we can use it to assess performance against our budget or targets, plan future trading activities, and also we can use the income statement like we just did to calculate indicators. We can also use it to improve. And the best two ways to improve are to either increase revenue or control expenses. So when we look at net profit margin, gross profit margin later on in Unit 4, some little tactics we can do are we can increase the selling price, we can improve our marketing, we can have better inventory management, which stops damages, improves quality, or stops theft. We can move to a better location. We can provide better customer service to reduce returns. We can have appropriate rostering to maximize our sales, or we can even be energy efficient to lower other expenses. So those are some little ways to increase revenue, control expenses. So when you're going through your theory, making sure we pick those out. Anyway, thank you for watching. Like, share, subscribe, and I will see you next time where we do the final video for Unit 3. See ya.